Hi. So welcome to this next section. We looked at the business organizations in the previous session. Let's look at how businesses can survive. You cannot live in a vacuum as a business organization. You need some structures, some systems to support your operations. So there is always somebody to scratch someone's back so that the person can survive as a going concern, right? So let's take a very clear look at the concept of stakeholder systems that support an organization to survive as a going concern. Note again, no organization can live as an island or live in a vacuum. They always need some systems and structures that will support them in order to survive and be sustainable in the immediate and then in the long run. All right. So last week, like I said, we looked at the type of business organizations, the advantages, the disadvantages. And so let's look at how businesses can survive. This is a two-part series or lecture. We take the first part, which is the stakeholders, after which we look at the environment, both the immediate environment and then the wider environment that the businesses survive or use in running to sustain themselves as a going concern. So general knowledge, let's look at it, what stakeholders are. Now, stakeholders are considered as any party whose actions impact on the operations of the organization, or any party who is affected by the operations of the organization. So they both influence and are influenced by the operations of the organizations. It was concocted sometime way back in 1963 in an internal memo at the Stanford Research Institute. All right. I also recommend this particular book, the Cambridge Handbook of Stakeholder Theory. It gives so much insight into what this concept of stakeholder is, the ethics, the norms, and then the practices of stakeholder and how it impacts an organization, the dimensions and its accountability issues. So the Cambridge Handbook of Stakeholder is a whole voluminous book. It has a lot and lot of dimensions in terms of the concept of stakeholder. All right. Stakeholders are classified into three. We have the internal stakeholders, the connected, and then the external. The internal stakeholders are principally those who are involved in the day-to-day running of the organizations. So basically, internal stakeholders are the employees and then the managers of the organizations. And then we have the external. They are the outside folks who are impacted by the activities of the organization. Typical examples of external stakeholders are the government, pressure groups, local communities, professional bodies, okay, regulatory agencies. These are the external stakeholders. The connected stakeholders, they link the two. They link the internal to the external. All right, so typical examples of connected stakeholders are the shareholders, the customers, the suppliers, the bankers. All right. So take note of this, and we should always be able to disaggregate or segregate stakeholders into the I's. We call them I's: internal, connected, and then external. So in your own time, try to find out any two internal stakeholders of a sole trader, of a partnership, and a limited liability company, or even of a cooperative or mutual association. Right. Now, varying needs of stakeholders. Every stakeholder has his or her needs. Ask yourself, what will shareholders need from an organization? They need enough returns so that their stock prices could increase. Customers need quality products from the organizations so that they will have value for money for whatever they give out to the organizations. Similarly, managers will want bonuses, they want job security and job satisfaction, they want higher bonuses. Same applies to employees. So we should know that not all employee or not all stakeholder needs could be met. You meet these particular stakeholders' needs and you have to sacrifice the others. So there's always a trade-off between stakeholder needs, which creates conflict in business management, so far as we want to maintain or sustain the interest of stakeholders. Now, I cited examples of what we need to provide to some stakeholders. So management, employees, job security, promotion, wages, salaries, job satisfaction. How would they respond to risk if you do not provide them with these? They'll resort to strike actions, resignations, or even refusal to relocate to where the business moves them to. Connected stakeholders, I started the example in the earlier discussion. So for each of these connected stakeholder, ask yourself, what would they need from the organization, right? And how would they respond if these needs are not met? The external stakeholders, which we have listed here, government, pressure groups, professional bodies, how do you think each of these above connected external stakeholders would respond if their needs are not met? Government, for example, if you don't pay your taxes accurately or you try to evade and avoid taxes, what would you think the government would do? Government could put sanctions on you. You could end up not getting the conducive environment to operate, which would affect your long-term prospects of the organizations, right? So like I said, meeting these particular stakeholders' need could affect the interests of the others. If you want to improve the community systems, build boreholes, reduce carbon monoxide emissions, it involves cost. Once you have to spend so much cost to undertake sustainability activities, you should know that your expenses will rise, your profits will drop. Managers might end up getting lower bonuses, all right? Government can also get reduced taxation because expenses rise. And most of these expenses are tax allowable. So you end up cutting edges so that the government can also get some reduced taxes, because at the end of the day, you satisfy one side and the other side will have to suffer the consequences, all right? So let's look at how to manage this stakeholder conflict. Interest of stakeholders will vary. They may not be the same. Management and shareholders, what will happen? Management want to reward themselves with bonuses. Why will shareholders be unhappy? If they are rewarding themselves with bonuses, with higher bonuses, it means there will be less retained profits, which could impact on the dividends that will be paid to the shareholders, all right? Similarly, compare shareholders to customers. Customers will want reduction in selling prices. Reduce the selling prices, what will happen? You get lower revenues, you get lower profits, and it will affect the retained earnings that shareholders would need to rely on for their dividend payments. Shareholders and society, I cited that one as well. So you can see that satisfy this group and the other group will have to pay for the consequences. So we need to manage these conflicts. And Mendeley brought up a matrix stating that let's look at the level of power of each stakeholder over the organization and the level of interest of each stakeholder in the particular decision making. So this matrix was developed, it says, per Mendeley's definitions. And of course, it makes a lot of sense. It says that those stakeholders with low interest in the organization and with low power over the organization, minimal effort, provide them with the minimal support as possible. Those stakeholders with high power over the organization but low interest in the organization, keep them satisfied, give them the information they need because they have power to decide how your organization runs. Those stakeholders that have high power, all right, they have high power over the organization and they also have high interest in the organization. They are the key players. For them, provide them with anything and everything that they need. But those stakeholders with low interest in the organization, but high power, keep them informed. They have power, keep them informed so that they don't take any actions that will affect the long-term effects of the organizations. All right, so give yourself, take this example and then let's try and see work through at your own pace. In the forestry business, it leases large woodland from the government. It employs 2,000 staff. It supplies 200 wood to 300 small businesses. Profitability has dropped considerably within this year. Companies struggling to pay dividends and 3 main shareholders who hold 20% each. These are significant majority stakeholders. They alone compose 60% of the shareholding, are angry that the company is struggling to pay dividends. Many other shareholders, but none own greater than 1%. The 3 main shareholders, they want the directors to make 200 people redundant. Employees are unhappy and they do not have a union, right? The question is this: using Mendeley's matrix, for each of these stakeholders, try to complete the grade as below. So pick one after the other: the customer, Find out their level of interest. So the first example is done. Customers, they are low. As long as service is not affected, their level of interest, all right. The level of power over the company, low. They are not the only customer. We have more customers. So low interest, low power, minimal effort. Do same for the majority shareholders. Remember, they have high power. What about their interest? Is it high? Are you going to keep them informed or keep them satisfied? Or they are key players? Take note of that. So you can work through this at your own pace, right? So 3 theories have been proposed to help in managing this ownership and then management debate, this stakeholder stuff. And we have the agency theory, which deals with principal and agent relationships. Stewardship theory, where managers are held as people who should run the organization and be held accountable for every action that they take. And then the stakeholder theory, which is quite pervasive and material. Now let's look at the agency theory. Management want to get their interests always satisfied. They want bonuses, high salaries and wages. And they will only look after performance of the company where their goals coincide with their own, right? So take a typical example with WorldCom, where they were rewarding directors for increasing share stock prices. By the end of the day, ask yourself, was it true? It's quite an interesting story to read, where managers will sometimes cook the books so that the shareholders might think that everything is working well. Shareholders here becomes the principal, and the managers are the agents who run this business in the interest of the principal. So sometimes these agents will cook the books just to satisfy their principals, only with the idea that they want to gain some further interest in terms of bonuses and salaries and high pegs, right? Take a typical look of that. So again, there's another example here with the site. Look at it where you see managers trying to gain more bonuses. They close some branches. Some jobs have to be lost so that at the end of the day, they can increase or maximize their earnings or their gains at the detriment of the larger stakeholder group. All right. For the stewardship theory, like I said, managers are seen as stewards. They are just managing the organization. They have been given this mandate to account to their owners. And they will use these in ways that are consistent with the overall strategy of the organization. Key principle is that they must run this business and be held accountable and to account to the owners. Again, shareholders and owners becomes these masters over these stewards. And then the stakeholder theory approaches it in quite a similar way, organic view of the organization. And what it is more or less a combination of the agency and the theory, I would say so. It's the development of the notion of stewardship. It states that management has the duty of care, not just to the owners, but to the wider stakeholder community. So they are not just accounting to the providers of capital, but to every other person whose actions are affected or affect the operations of the organizations. So stakeholder theory is quite pervasive. And if you are not careful, you end up arguing and arguing and arguing. There are branches. We have the normative, and then we have the critical aspect of it. So stakeholder theory makes a lot of sense, again, but it has a lot of questions and defects which have been raised by scholars. Which one of the following is classed as a connected stakeholder? Quite easy, right? Very easy. Which one of the following would be the most financially dependent on the company making a profit? Profit. They're interested in the profit. Very easy, right? Is it supplier? Supplier wants cash. Employees, they want their salaries, they will get it. Customer, reduce prices. Tax authorities, they hire the profit, they hire their taxes. Easy. Quick quiz. Again, number 3, let's see which one is true or false. Interest of customers and shareholders can conflict. Very easy. True, right? Satisfy this, and you have to pay the consequences from the other person revolting or protesting. The public is the legitimate stakeholder of a PLC listed company on the stock exchange. Is the public a legitimate stakeholder? Perfectly. You cannot do without the public. Thank you. So we'll look at the next section. We'll look at the next part of this, where we'll look at the wider business community. All right. We'll look at the wider business community and then the immediate business context in the next recording. All right. See you soon and take care. Bye.